I want to tell you about a pattern that I see repeat itself over and over again in retirement, and it breaks my heart every single time. A couple plans for retirement together. They save together, they invest together, they dream together about what life will look like when the work is finally done. And then one of them passes away, usually the husband first. Statistically, women outlive men by an average of 5 to 6 years. And in the months after the funeral, after the grief and the shock and the paperwork, the surviving spouse opens their financial statements and they discover something devastating. Their monthly income just dropped by 30%, 40%, sometimes 50%. The pension that paid $2,400 a month, it is now paying $1,200, or nothing at all. The Social Security check that was the bigger of the two, gone. The survivor gets to keep only one. And the life insurance that was supposed to cover the gap, it ran out years ago, or was never enough. And the surviving spouse, most often a woman in her 70s or 80s, alone for the first time in decades, grieving the person she built her life with, is now also facing a financial crisis. Not because the couple failed to plan, but because they planned as a unit and never thought carefully about what happens when the unit becomes one. Today we are going to fix that. We are going to walk through the most important retirement planning decisions married couples must make together and make correctly to protect whichever one of them is left behind. Hey everyone, welcome back to Life Advice. Today's video is one I believe every married couple approaching or already in retirement needs to watch together. So if you have a spouse or partner, please share this video with them, because the decisions we cover today affect both of your financial futures, and they should be made together. Let's get into it. Let's start with the fundamental problem, and it is this. Most married couples plan their retirement as if both spouses will always be present. They calculate their combined income, their combined expenses, their combined portfolio. Everything is we. How much do we need? What do we spend? When do we retire? And that joint planning produces a joint retirement plan. A plan that works beautifully as long as both spouses are alive, but a plan that can collapse catastrophically the moment one of them is not. Here is the statistical reality that most couples do not fully absorb. According to the US Census Bureau, approximately 36% of women aged 65 and older are widows. That number rises to more than 50% for women over 75. Half. More than half of women over 75 are living alone, and a significant portion of them are navigating that solo life with dramatically less income than they had when their spouse was alive. And it is not just women. Male widowers face their own version of this challenge, often with less experience managing household finances, less familiarity with benefit structures, and an emotional vulnerability that makes complex financial decisions especially difficult in the immediate aftermath of loss. The widowhood financial crisis is one of the most common and least discussed retirement disasters in America, and almost all of it is preventable. But prevention requires couples to do something that feels unnatural and uncomfortable, to plan explicitly and specifically for the scenario where one of them is gone. That means asking hard questions. What does our income look like if you die first? What does it look like if I die first? Are those two scenarios equally protected, or is one of us walking a financial tightrope that the other person never even knew existed? For most couples, when they actually run the numbers on these questions for the first time, the answers are sobering. Let's look at exactly where the income drops happen and how to prevent them. When one spouse dies, retirement income can drop sharply from 3 separate sources simultaneously. Understanding each one is essential for building a plan that protects the survivor. If both spouses receive Social Security, the survivor gets to keep only one benefit, the larger of the two. The smaller benefit disappears entirely at the first spouse's death. Let me show you what this means in real dollars. Say the husband receives $2,400 per month in Social Security, and the wife receives $1,600 per month. Combined, they receive $4,000 per month. When the husband dies, his $2,400 benefit becomes the survivor benefit. The wife receives $2,400 per month. Her own $1,600 benefit disappears. Their household Social Security income drops from $4,000 to $2,400, a 40% reduction. But the expenses do not drop 40%. Housing costs are essentially the same. You do not need half a house because you lost half your household. Utilities are nearly the same. Insurance premiums are the same or higher. Food and transportation costs decline modestly, but nowhere near proportionally to the income drop. The surviving spouse is left covering most of the same expenses with dramatically less income. This is the Social Security widow gap, and it is one of the most predictable and most devastating income shocks in all of retirement planning. The solution, which we will cover in depth shortly, involves deliberate Social Security claiming strategies that specifically optimize the survivor benefit, not just the couple's total income while both are alive. If one or both spouses receive a pension, the death of the pension holder can trigger a dramatic income reduction or complete elimination of that income. This depends entirely on which pension payout option was chosen at retirement. Pensions typically offer multiple payment options. A single life annuity pays the maximum monthly amount for the retiree's lifetime only. When the retiree dies, payments stop completely. A joint and survivor annuity pays a reduced monthly amount during the retiree's lifetime, but continues paying a percentage, typically 50%, 75%, or 100%, to the surviving spouse after the retiree's death. Here is where the fatal mistake happens. Many retirees, attracted by the higher monthly payment of the single life option, choose the single life annuity without fully thinking through what that means for their spouse. A retiree choosing between $2,800 per month for life only versus $2,300 per month with 50% survivor benefit might choose $2,800 because it looks better on paper. But if that retiree dies at 74, their spouse, who may live another 15 years, loses $1,150 per month of income permanently. The $500 monthly difference they enjoyed for a few years cost their surviving spouse hundreds of thousands of dollars in lifetime income. If your pension is already in payout and you chose the single life option, this is critical information your spouse needs to know, because their financial plan after your death must account for that income disappearing entirely. And if you have not yet selected a pension option, the joint and survivor choice is almost always the more protective decision for your household as a whole. The third income drop is more variable but equally important. When one spouse dies, the surviving spouse becomes a single tax filer, and single tax filers face higher tax rates on the same income than married couples filing jointly. The income thresholds for every tax bracket are lower for single filers. The threshold for Social Security taxation is lower. The IRMAA Medicare surcharge thresholds are lower. A surviving spouse who is comfortably in the 12% or 22% bracket as a married couple can find themselves pushed into the 22% or 24% bracket, paying thousands more in taxes per year simply because of their filing status change. And they are doing this at the worst possible time, during grief, on a reduced income, with no partner to share the burden. This tax cliff, which planners sometimes call the widow's tax penalty, is a genuinely significant financial event. And it is another reason why Roth conversions during the gap years are so valuable for married couples. Building a Roth account base reduces the RMD burden that will drive income after the first death and provides tax-free income that helps the survivor manage the higher single-filer tax environment. Let's go deep on Social Security strategy for couples, because this is where the biggest mistakes and the biggest opportunities live. Most couples approach Social Security claiming with one primary question: when should each of us claim to maximize our combined income? And that is a reasonable question, but it is the wrong first question. The right first question is this: what Social Security strategy maximizes the income of whichever one of us is left behind? Those are two different questions, and they frequently produce two different answers. Here is the foundational principle. The survivor benefit a widow or widower receives is equal to the deceased spouse's benefit at the time of death, including any delayed claiming credits, which means the higher the deceased spouse's benefit, the higher the survivor benefit. And the most powerful way to increase a benefit is to delay claiming, earning 8% per year in delayed credits up to age 70. This creates a very specific and powerful strategy for most married couples. The higher earning spouse, the one whose benefit will become the survivor benefit, should delay claiming as long as possible, ideally to age 70. The lower earning spouse can claim earlier to bring in some household income while the higher earner waits. Let me show you the numbers. Say the higher earning spouse's full retirement age benefit at 67 is $2,400. If they claim at 62, they receive $1,680. If they claim at 70, they receive $2,976. The difference is $1,296 per month, $15,552 per year for the rest of the survivor's life. Over a 15-year widowhood, that difference is $233,280. Over 20 years, it is $311,040. The decision of when the higher earning spouse claims Social Security is not just a personal retirement decision. It is a life insurance decision for their surviving spouse. Every year of delay is purchasing a larger, inflation-adjusted, government-guaranteed survivor benefit. And unlike life insurance, which has premiums, policy limits, and expiration dates, the Social Security survivor benefit lasts for the rest of the survivor's life and adjusts for inflation every year. Now let's talk about the lower earning spouse's decision. If the lower earner has their own benefit, not just a spousal benefit, their claiming decision affects their own benefit amount, but does not affect the survivor benefit they will receive if their spouse dies first. So the lower earner has more flexibility to claim earlier if household income is needed, as long as the higher earner is on track to delay. There is also a spousal benefit strategy worth understanding. A spouse who earns significantly less than their partner may be entitled to a spousal benefit, up to 50% of the higher earner's full retirement age benefit. The spousal benefit is only available if the higher earning spouse has already claimed. So for couples where one spouse has little or no Social Security earnings history, the higher earner's claiming decision affects when spousal benefits can begin. The key takeaway for every married couple is this: do not make Social Security claiming decisions individually. Model them jointly. Specifically, model what happens to household income if one spouse dies at 70, at 75, at 80. Make sure whichever spouse is left behind, in whichever scenario, has enough income to live with dignity and security. Now let's talk about something that is less glamorous than Social Security strategy, but equally critical: organization. Because one of the most common and most devastating problems surviving spouses face is not a lack of money, it is a lack of information. When one spouse handles most of the family finances, as is still the case in many marriages, the other spouse may have little knowledge of where accounts are, what they contain, who the advisors are, what the passwords are, or what documents exist. And when the financially managing spouse dies, often suddenly and without warning, the surviving spouse is left to reconstruct their entire financial picture from scratch, while grieving, while dealing with funeral arrangements, while managing legal paperwork, while trying to figure out how to pay the utility bill. This is an entirely preventable crisis, and fixing it requires one thing: a financial roadmap document, sometimes called a family financial binder or legacy binder, that gives your surviving spouse everything they need to take over the financial management of the household immediately. This document should include, at minimum, the following: a complete list of every financial account, bank accounts, investment accounts, retirement accounts, insurance policies, with account numbers, institution names, and contact information. A list of all automatic payments and recurring bills with the accounts they draw from. Login credentials for online accounts, investment platforms, and bill payment systems. Contact information for your financial advisor, CPA, insurance agent, and estate planning attorney. The location of all important documents: will, trust, insurance policies, social security cards, birth certificates, marriage certificate, and property deeds. A clear explanation of your income sources: what Social Security pays, what any pension pays, and what the survivor benefit rules are for each. This document does not replace estate planning, it supplements it. An estate plan tells the legal system what to do with your assets. A financial roadmap tells your spouse what they need to do next week. Both are essential. If you do not have this document, creating it is one of the most loving things you can do for your spouse this week. Not this year, this week. Because the most common time this document is needed is when you least expected it to be. Let me give you a practical framework for building a retirement plan that genuinely protects both spouses, not just the household as a whole. The framework has 4 components. Every retirement income plan should be stress tested against 2 specific scenarios. What does monthly income and monthly expenses look like if the husband dies first at age 75? What does it look like if the wife dies first at age 75? Run both scenarios with real numbers. Identify the gap, if there is one, between income and expenses in each scenario. Then build strategies specifically designed to close those gaps. If the survivor scenario reveals a significant income shortfall, which it often does, that shortfall is not acceptable to leave unaddressed. It requires specific action: optimizing Social Security claiming for the survivor benefit, choosing the right pension payout option, maintaining adequate life insurance, building Roth accounts that reduce the survivor's tax burden, or a combination of all of these. As we covered in depth, the higher earner should delay claiming to maximize the survivor benefit. This is not the right answer for every couple in every situation, but it is the right starting point, and any deviation from it should be a deliberate, informed choice, not a default that happens because you did not think through the survivor consequences. If either spouse is approaching pension payout decisions, or has already made them, the joint and survivor option deserves serious consideration, even at the cost of a lower monthly payment. The specific right choice depends on the couple's health, age gap, other income sources, and life insurance coverage. But the decision should be made with full awareness of what the surviving spouse's income picture looks like under each option. Life insurance is most valuable during the years when income streams are not yet fully established and survivor income gaps are largest. For couples in their 60s and early 70s where Social Security has not yet been maximized and pension payout elections have recently been made, maintaining appropriate term or permanent life insurance can bridge the gap between the current plan and a fully survivor-protected one. As Social Security is maximized, as the estate is structured correctly, and as both spouses become familiar with the full financial picture, the need for life insurance typically decreases. But during the transition years, particularly if the higher earner has not yet claimed Social Security, life insurance provides critical protection for the survivor. Let me end with the most important message of this entire video. Retirement planning is not just about building enough wealth for two people to live comfortably together. It is about building a plan that protects whichever one of those two people outlives the other. A plan that says, no matter what happens, no matter who goes first, the person left behind will be financially secure. They will not face a dramatic income drop in the worst moment of their life. They will know where everything is. They will have enough. They will be okay. That is the standard every married couple should hold their retirement plan to. Not how much do we have together, but what does each of us have if the other is gone? The actions that get you there are specific and achievable. Delay the higher earner's Social Security to maximize the survivor benefit. Choose pension payout options that protect the surviving spouse. Build Roth accounts that reduce the survivor's future tax burden. Create a financial roadmap document so the surviving spouse has everything they need immediately. Run the survivor scenarios so you both know exactly where the gaps are and close them before they become crises. And perhaps most importantly, have this conversation together. Not one spouse managing the finances while the other stays in the dark. Both of you, together. Because the decisions that protect your spouse most are the ones you make jointly, with full understanding of what is at stake for each of you. Drop a comment below and tell me, have you and your spouse run the survivor scenarios for your retirement plan? Is one of you more involved in the finances than the other? Let's talk about it. I read every comment. If this video helped you, please share it with every married couple you know who is retired or approaching retirement. It could literally change their financial future. Subscribe to Life Advice for a new video every week. I will see you in the next one. Take care.